Welcome to Stocks in Translation, our essential conversation cutting through the noisy numbers, the market mayhem, and the hyperbole to give you the information you need for your portfolio. Today, I'm joined by Sydney Freed, as always, and also a very special guest, Jaspreet Singh. He is the CEO of Briefs Media and also the host of the Minority Mindset Show, which you can catch on YouTube. And today we're going to be talking about investor psychology. You know, humans have this peculiar relationship with fear and greed, how to leverage that in investing or just build a digital brand. Our word of the day is debt. Most of us got some. Some of us are going to repay it. We're going to talk about why it matters. And this episode brought to you by the number 929 billion. That is the size of the maturity wall, and that's in dollars, faced by commercial real estate this year alone. What people are getting wrong about CRE. So Jaspreet, before we take a deep dive on anything in particular, want to get your view of where we are in the markets. You know, we just had this kind of painful rotation, but the major indices still relatively high by their record highs. Where do you think we are right now?
Well, the economy is, I like to say, look at a snapshot of it. Everything looks strong. People are spending, businesses are hiring, everything looks good. But if we make it into more of a live image, a moving image of what's happening, what we're also seeing at the same time is we're seeing consumer spending start to pull back. We're starting to see a little bit of a slowdown in the economy, and more and more businesses are getting a little bit more cautious on their hiring. So markets are strong, the economy is strong, everything is great, but we're starting to see a slowdown in a lot of different factors. Inflation, the compounding inflation from 2021 to 2022 to 2023, and now in 2024, it looks like it's starting to impact the pockets of the American people, which is impacting how they spend, which will ultimately impact businesses. So that's where, if you look at a moving image, you start to see there's a little bit more red flags of what's happening in the economy.
You know, I love that word compounding, and it kind of relates to our phrase, our word of the day, which is debt. So let's just go, let me define that here, and then we can take a deep dive into it. Debt, and I think we all kind of know what this is, but debt is money borrowed by one party from another, which must be repaid with interest. That's key there, with interest. It can be secured, that is backed by collateral, or it can be unsecured, and it includes loans, credit cards, and bonds. And I know you talk a lot about debt on your show. What do you think about where we are, the American people, with the sovereign debt and then the private debt?
Well, I think debt at its basic root is you're borrowing tomorrow's income to spend it today. And the price of you borrowing the future income to spend it today is interest. Now, debt can be used to make more money. If you use debt to buy an income-producing asset, well, now that thing that you purchased can pay for that debt, and it can pay for the interest and put some money in your pocket. The problem is we have a lot of people that don't use debt in that way. The average American today has more household debt than really ever before. We broke a record in credit card debt. And so what does that mean? We have a lot of people that are borrowing money because they're spending money they don't have, and now they have to pay that money back. Well, that means your payments back are going to be more expensive. But now if you couple that with the fact that we have the highest interest rates that we've seen in the last 2 decades plus,
yes, that
means your payments are higher because of the interest rates as well. So it's a double whammy that's impacting people. So more and more people are having to pay more of their paycheck just to pay back their yesterday's purchases on the people side. But you also have the same thing like you were talking about with corporations and commercial real estate. And then you have the same issue with our government, our federal debt, which is probably
kind of like different rules apply, but they still have problems.
They do have problems. And I think very similar rules apply, but many people will say it's different because the government can just print more money, but that has an impact as well.
Jaspreet, you recently talked about millennials and Gen Z going into debt to afford their vacations. I think I wrote the numbers here: 47% for millennials, 42% for Gen Z.
Great rant, by the way.
Great rant. Do you think these people should just kind of hold out till the Fed starts to cut interest rates? I mean, I'm kind of joking, but I'm kind of not.
Our blood pressure is rising. No, what I said in that video was this is one of the dumbest things that you can do. And the reason why is because you are spending money you don't have to buy something that's not going to make you any money, and you're paying the highest interest rates possible. So what ends up happening, I'm going to paint a little scenario here because what happens is now The first time you do this, because you're 21, 22, 25 years old, you're young, you're out of college, you're making a little bit of money, and everybody's spending money they don't have. So it's like, okay, you know what, let's go to Cancun, no big deal, a couple $1,000s. Amex says I can do it. Everyone's going to finance it. Who cares? So now you finance this little trip to Cancun. You got to pay a little bit of interest on it, but no big deal. Once you do it once, well, then you start to look at the buy now, pay later. You start to pay a little bit more. You start to do a little bit more. And then now it starts to add up. And then what ends up happening is you buy a dog. And because everybody has a dog nowadays.
I like to think your life changes for the better around this, but
Well, I'm
You're about
looking
to
at
blame Spot? Poor Spot, the dog?
We'll call this dog Cheeto.
Cheeto.
okay.
So you go and you buy this dog Cheeto. And the problem with overspending is it's kind of like eating flaming hot Cheetos, because you can't eat one. You eat one and then you're going to eat the whole bag. So now what ends up happening is your dog Cheeto is giving you all this happiness in your life, but then Cheeto gets sick. And so what do? You take Cheeto to the
well,
veterinarian.
you gotta fix the dog.
But the veterinarian says he needs an operation. Poor little Cheeto needs a $2,000 knee
You
operation.
got an Amex card here.
The Amex is maxed out.
Oh.
So now you have to look for an alternative solution.
Open another one.
Affirm.
And exactly, but it's more difficult now. You become desperate, and so you need a solution. So now you look for, what can I do to take care of poor little Cheeto, because I have to take care of Cheeto. So now you look for the alternative options, and there's things like Care Credit out there, which are going to charge you 32 to 33% APR. But you got to take care of your dog. So now you put that on your Care Credit. You spend that $2,000. Cheeto's okay, but now you're mad at the vet, you're mad at your landlord, you're mad at your dog, you're mad at Walmart for charging so much money for groceries, and everything is upsetting because of how expensive life is. But it didn't start with your Cheeto. It didn't start with that veterinarian. It started years prior. And I don't think most people understand how expensive 33% APR is. Like, we all know it's expensive.
It is eye-watering. And let's just, if you have some examples in real life, how that breaks down, because you spend $100, that's $33 out of that 100. That's just going to the interest payment for 1 year. I mean, just expand on that.
We'll talk about $100. If I could invest $100 a month from the age of 21 to 66,
Compounding.
and I could get a 32% return on my money annually, I wouldn't retire with $1 million or $10 million or $100 million or $500 million. I would retire with more than $1 billion with my $100 monthly investment, because I could get a 32% return. But that's what so many Americans are doing, because they got to take care of poor little Cheeto.
Oh, I feel bad for Cheeto.
I know I'm saying this in a funny way, but the reality is, it doesn't matter if it's a dog, it doesn't matter if it's a vacation. We spend money we don't have, because that's the American system. And that's where, look, it keeps the economy booming. It keeps my portfolio strong. You're making rich people richer. But I'm saying, look at yourself first. You're getting all these things which are making other people rich, because let me tell you something, investors, they love it. Because you keep spending, you make my stock portfolio stronger, you stay a tenant.
Well, you said yourself, if I have $100 and I invest at 33% interest, by the end of, I don't know, how many decades did we determine? 20, 30 years?
Yeah, 46 years.
Okay, so you got $1 billion. That could be your credit card company sitting on the other side with your money, and you do that with volume, you can understand the economics of their business on the back of yours.
And you can buy Cheeto once you have $1 billion instead of now.
You can buy a whole family of Cheetos.
Yes. All right, you're holding us. We're going to talk about debt. So we're going to keep the conversation here, but I want to talk about sovereign debt, and specifically an event that's coming up August 15th. You have a special program celebrating the 53-year anniversary of Nixon closing the gold window. This is not something everybody knows about, but way back in 1971, at least internationally, other central banks around the world used to be able to convert their digital dollars for gold and just warehouse it themselves. But Nixon said no. He was spending a lot of money on the Great Society. Vietnam War debts were going up, and a lot of other central banks were reclaiming their gold. So Nixon just shut it down, and that changed the monetary game. But what do you get out of that act, which kind of brought us into our modern fiat system?
Yeah, so there's 2 years that you have to understand if you want to understand how our money works. 1971, like you mentioned, when our dollar was taken off of the gold standard, but also 1913, because 1913 was when our central bank, which is the Federal Reserve Bank, was created. So the central bank, the Federal Reserve Bank, has the ability they're monitoring our monetary supply, which essentially means they can print money, create money. They can also change interest rates. But when you couple those two things together, where the Federal Reserve Bank can control our currency, and then now our money, our dollars, what we thought was money, is no longer backed by this precious metal, gold, that means now that our government has the ability to spend more money without much pushback, because the Federal Reserve Bank doesn't need more gold to justify more printing, because that gold was almost like collateral. If you wanted to borrow more money, the banks are going to say, well, how many assets do you have? What is your house value? What is your car value? Well, with the government, they're saying, well, don't look at our collateral, just print the money anyways. The impact of that is, of course, inflation. And so if you look at what has happened over the last 5 or so decades, between 1971 until now, what we've seen is the household income has grown by around 600%. But at the same time, what we've also seen is that car prices have grown by around 700%. Buying a home has grown by around 1,800%.
So a lot more.
And
by a factor of what, 10, 5, something in there?
Many multiples. But the real kicker here is household income in 1971 was based off of one person's income. Today it's two. So household income has grown, but there's also two people working, and it still hasn't been able to keep up with the rising price of things. What is that from? It's from inflation. Why does inflation happen? When you keep increasing the amount of dollars out there without increasing the amount of wealth. And so this is where, well, what is the cause? You look back at those 2 years, 1971 and 1913.
Hold that thought. We're going to expand on that, but we need to take a quick break right now. And after the jump, we're going to be talking about commercial real estate, how it compares to digital real estate, and a $1 trillion refinancing cliff. All right, we are back, and we were just talking, Jaspreet, about the sovereign debt situation of the United States, the fiscal position, why it's bad to borrow a bunch of money at 33%. But here's another number. I know before we do the number of the day, I could tell you had a burning
so I just wanted to back up. So the U.S. once had this gold standard. People could convert dollars to gold. Nixon ended it. Was it really that bad when we had the gold standard? Were we better off back then?
It's a loaded question.
It depends on who you ask. See, the problem that the government was facing was that they had a lot of debts that they couldn't pay. They were spending money that they didn't have. For the average person, for the average American, yeah, it's good, because for the average American, you don't want inflation, because you want actually deflation as a consumer. That makes your dollars more powerful. The government doesn't want deflation. The Federal Reserve Bank doesn't want deflation. That's a nightmare for them. So it depends on who you ask and which interest you're looking at.
Makes sense.
All right. Yeah, I would add to that conversation too. You never know exactly how the Federal Reserve is going to come down on any one particular issue. We got to get now to our sponsor, this episode brought to you by the number 929 billion, and that is dollars, and that is a number from Goldman Sachs that represents how much commercial real estate debt is coming due this year. It's called the maturity wall, money that needs to be repaid or refinanced, and that amount represents 20% of the sector's $4.7 trillion of debt. And this comes as commercial real estate volumes are falling off a cliff. 2023 volumes cut in half for CRE. And we're talking about commercial real estate here. And I've been hearing about this for years. Is it really that big of a problem?
The way the real estate debt works is a little bit different than residential real estate, because if I go to buy a home, I can get a 30-year fixed rate mortgage. If I want to go out and invest in an office building, generally no. It's generally a 3 or 5 year readjusting loan. And so what has happened was you have all these real estate investors, 2019, 2020, 2021, when interest rates were at their lowest levels ever and valuations were booming for many parts of real estate, not all, that then use it as an opportunity to refinance, get a lower interest rate. Well, okay, it was fine when interest rates were low, but then what ended up happening was interest rates went a whole lot higher. And some sectors of real estate saw their valuations fall, particularly office real estate, because, well, many people started working from home and businesses started ending or shortening or reducing the size of the leases. So now, as a landlord, what generally would happen in a normal time, we're going to call this not a normal time, is when your costs go up, your debt costs go up, you pass it down to your tenants, your office tenants, your retail tenants, your residential tenants, you pass the cost on to them, which works. But now if you're entering a time where you don't have any office tenants or you're only half leased, you can't really raise your prices. I mean, you're already struggling to make the payments as it is. So if payments go up for you, which they are, you're in a tough situation. Either you say, you know what, forget the next monthly payment, I'll just mail in my keys, because that's what we've been seeing happen, more that pre-foreclosure in the office market. And then if you look at the businesses that are catering, the landlords that are catering to businesses, well, some businesses aren't making as much money as they would like. And if that business cannot absorb the higher rent costs, well, now you're again in a tougher situation. Either the business says, well, I'm going to have to move out if you're going to charge me more, or the landlord says, I can't make the payments if I don't charge you more. So it starts to create more of those predicaments. Now, residential real estate is a little bit different, where we're seeing apartment complexes. I mean, rental rates have been booming. And so a lot of residential landlords in that sense have been okay. But in the other sectors, it's a big concern, which is why you have all these agencies, the real estate investors and groups that are pushing for lower interest rates and putting a lot of pressure on the Fed, because it's going to create a wave of foreclosures if in 24 months interest rates continue to stay high.
Go ahead.
What do you see for commercial real estate? Do you see, there's a day where we kind of return to needing all these big buildings and people want to invest, or do you think it's just kind of going to keep going on this downward trend?
Well, for what type? Are we talking about office real estate?
I guess office, yeah.
Well, I think what ends up happening is many businesses will need to be more productive. As anytime you see an economic slowdown, businesses will need to be more efficient and more productive. That is what we've seen happen in every single recession in the last century. So now, if we see an economic slowdown and businesses start to see more of a pullback, they have to get tighter. They have to let people go, and they have to figure out, how can we be profitable? How can we make more money? And some businesses, more businesses, will likely say, we need to be more efficient. We need to get back in the office. So when businesses get more desperate, they get more desperate and they find alternative ways. And so when you have a time where money is everywhere and businesses are making big profits, then they can be more lax with their perks and more lax with all their benefits that they can give out. But when money gets tight, those perks and benefits are the first things to be cut. So I would expect that if you see a pull down in the economy, that would push many businesses to say, we got to get back in the office.
Really interesting. We want to continue the conversation about real estate right here as we wrap up here for another episode of Who Wore It Better. And today the contest is going to be all about real estate. We're pitting traditional real estate against digital real estate or online brands. And we want to know, how do the opportunities in real world bricks and mortar, how do they stack up against the monetization of digital properties like blogs, YouTube channels, and e-com stores? So Jaspreet, you've dabbled in both of these realms here. And we want to ask you, so where does the best opportunity lie now, in traditional real estate or online?
Well, I'll tell you exactly what I do.
Yes.
Because I do both. So I have a digital brand, obviously Minority Mindsets is my YouTube channel. Briefs Media is my digital media company. I take the money from there and I use it to buy physical real estate. Digital media, digital real estate, you can grow much quicker. You can see a lot of success and a lot of dollars quickly, but it's also fleeting. I mean, if YouTube changes their algorithm, well, you could see a big effect. When AI changed the search engine optimization algorithm for Google searches, blogs were getting slapped left and right. Revenue tanked for many blogs. So digital real estate is extremely powerful. I love it. Physical real estate has slower growth, slower returns, but it's much more stable long term. So use the digital real estate to finance and fund your physical real estate.
Love it.
Mm-hmm. It's time to get personal.
All right.
You told us offline that you were once conned. I think it was your first business. Can you tell us a little bit about that?
Well,
Has to do with socks?
I was conned in many businesses.
Oh, Lord.
In the sock business particularly, when I realized I wanted to be on the internet, I wanted to build something that I felt was scalable, that I could grow without me. And so that's what got me into the sock industry. And I launched the business actually through Kickstarter as a way to pre-sell some of the socks. And I had hired a marketing company. The marketing company was a scam. I paid them thousands of dollars and I never heard from them again.
Wow.
Still, we had a very successful launch. And this is more than a decade ago. This is a long time ago. And so I was so frustrated because I didn't grow up with any financial education, entrepreneurship education. I had to do this all in secret. And so I then had the idea to start creating content around thinking differently than the majority of people. And so I wasn't a very good writer because English is my second language. So I decided to make videos on YouTube under the alias Minority Mindset, with the whole idea being you have to think differently than the majority of people. And slowly that started to grow. And then it became 100,000 subscribers on YouTube, which I never thought 100,000 people would want to watch a random guy on YouTube like me. And
that's how we found you, by the way.
it's crazy with the power of digital real estate.
Yes.
And so then I eventually decided to put less resources, time, and energy towards the sock business, more towards my YouTube channel, and then build Briefs Media because that was more along my passion. I liked the sock business because I liked entrepreneurship, but I wasn't so passionate about socks. I love the financial media side of things, which got me really passionate about Briefs Media, but that's how it all started with the digital brand that I have now.
Were you able to recoup any of that money that you got conned out of, or was there any way to get that back?
The money that I paid the marketing company was gone. I called an attorney, and the attorney fees were going to be a lot more expensive than the money that I was going to get back. So we just kept going forward, and we recouped that money in other places.
I mean, how was your mindset around that? Did it kind of make you want to stop, or you just said full charge ahead?
Well, I was also a lot younger, so I was very hard-headed.
Risk taker.
So I was a risk taker. I was hard-headed, and I went to the gym. I lifted really heavy weights. I got it out, and then I got
That solves
back.
a lot of problems. You'd be surprised.
It does.
Yeah.
Just lift something heavier, and you'll feel better.
Yeah. I want to, we've been talking about thinking contrary to the herd and just kind of doing things a little bit differently. And one of the things that pops up in the business cycle a lot of times is you got to kind of go against the grain. So when there's a recession, there's blood on the streets. That's the time to really think about buying certain assets, not all, but certain. Tell us how you think about recessions and the opportunities they provide.
Yeah, I mean, if you want to build wealth in a recession, you have to understand poop. P-O-O-P.
Oh.
Because what poop
I hope this
is-
stands for something.
Yes, Sam.
Well, you gotta listen. You gotta understand your poop. That's panic leads to overselling, leads to opportunity, leads to profit. This is the same thing that we've seen recession after recession after recession, and it's made some people very rich, but most people don't even understand how poop works. So what does that mean? 2020 pandemic happens. Markets are crashing. People are panicking. When they panic, what do? They oversell. Why? Because, well, the market's going to collapse, the economy's shut down, the world is going to end, everybody's going to die. I mean, that was kind of the narrative at that time.
Sure.
Which created opportunity for the financially savvy because you see, well, either I'm going to die or I can get rich, or you can buy stocks at a huge discount. I mean, I think it was the fastest 30% sell-off ever, faster than the Great Depression.
Weeks, maybe a week.
It was
crazy.
It was crazy. So now, I mean, even if you don't know what you're doing, you can just buy a share of the S&P 500 and own a little bit of, some of the biggest companies, which created opportunity, which then lead to profits as then markets grew again. So the same poop happened in 2008. 2008, same thing with the stock market, but we'll talk about real estate. I mean, it was panic, which led to overselling. And I know this firsthand because that's when I started investing in real estate, was after the 2008 meltdown. I didn't have a lot of money then. I was young. And everybody was talking about how real estate created foreclosures, real estate created bankruptcies, real estate didn't create wealth, which created that overselling, which then created opportunity. In Detroit, which is where we're based, Metro Detroit, you could buy real estate for 91 cents off, which then created the opportunity for profits. So if you understand poop, you can find the opportunities in real estate.
Any final words for investors?
Think differently, do your research, don't be an emotional investor. Understand the trends, be prepared, and be financially educated.
I can't top that. Can you? Sid?
No, not at all. I'm still thinking about the poop. So,
thank you for watching Stocks in Translation. Jaspreet, thank you for stopping by. Sid,
Thank you.
as always, keep your dial locked to Yahoo Finance.